This is the Daily Market Rundown live from the Tradelo Trading floor. It's November the 13th. Some highlights from today's show. Musk, Trump's go-to guy, and the US CPI is now in focus, and yields are posing a headwind for equities. Good day, traders, and welcome. Let's start and talk a little bit about yesterday's trading session. I think the key theme ever since the election result has been all about the dollar, and that is very much what some of the overnight news is all about. It's this consensus trade now that the United States dollar is going to reign supreme for a number of reasons. One, we have a fiscal spending program that is going to exceed all others. What this means is we'll have significant growth coming from the United States relative to all other economies around the world. And as a result of that, the Fed's not going to be able to cut as much as they would like to expect. Right now, we're looking at the implied odds. Markets think there's only about another 75 basis points of cuts coming from the Fed over the course of the next 12 months. Now, don't forget that the Fed told us not too long ago at the September meeting not too long ago at the September dot plot, that they expected ultimately they would cut another time perhaps this year. There's a very close call for that December meeting. The market still thinks we get a cut there, but moreover, the Fed believes via the dot plot they're going to cut 3 times next year. So the market's gone quite hawkish now on the Fed, and that's exactly what's priced into the dollar. And that's key to understand right now. This idea of dollar supremacy is already in the price. What we do now need to see is we actually need to see the Fed start to talk about this idea of perhaps only cutting at every other meeting or even more. Okay, until we get that, the dollar is now fully priced for this hawkish Fed theme for most of 2025. Now, if we go and take a look at some of the overnight news, Trump has named Elon Musk head of Doge, quite a fitting use of wording there, and Doge is just all about pretty much coming in and making the government more efficient. He's also of course elected Vivek, who was one of those that was challenging for the Republican nominee. Two really interesting guys. I think two candidates that will be very well sort of geared towards this sort of job. They are both very much about being efficient, not wasting, and both of them will do a very, very good job of this, and I think the market's quite excited about that. But what I kind of want to point towards is when Musk typically gets involved in things, what typically happens is some of these other companies do come under some sell-side pressure. Now, the example to keep in mind if you were trading back in 22 when he bought out Twitter, is you'll notice that we saw a lot of people talking about this idea that his focus is going to be off of Tesla, and as a result the stock price suffered a 43% drop-off in a space of less than a month. So again, I think there's something there. I think there's definitely something to keep an eye on in Tesla. Right now, don't forget, Tesla is very much hyping up on this idea that Trump is going to be very favorable for Tesla and very positive for Tesla. But the reality is that it's not exactly like Tesla's economics right now are blowing it out the park. So sure, Tesla is pricing in a very, very favorable regulatory outlook for the stock price, but that's in the price now. Okay, so don't be surprised over the course of the next couple of days and weeks as Elon starts to take on this Doge role to see Tesla stock come under some sell side pressure. There will of course be a couple of days where this narrative will become a narrative where someone says that because Elon is now working on Doge, as a result of that he's taking his eye off Tesla, and that may come as soon as Q1. I think Q1 is going to be the first time you start to pay attention to the impact of him taking on, of course, more responsibility. So keep an eye on that. And then if we take a look, of course, today is all about CPI day. It's the key risk event for this week. And it's one that should be very, very closely watched. Not necessarily because of the fact that inflation's suddenly about to ramp and tick up higher, but because right now the bonds are very, very oversold, the dollar's very, very overbought. Okay, so there are two markets right now that are prime candidates for trades today, simply because of the nature of what's happened over the course of the last 2 weeks. We'll talk a little bit about yields in a minute, but let's do a little bit of a rundown for today. It's expected that the year over year will tick up from 2.4 to 2.6 now. What does that mean? Well, if we look at pretty much inflation the entire year, it's been contained. Okay, if anything, we can see the average in the purple line has gone absolutely sideways. It's just started to drift lower now over the course of the last 3 months. So really, we are seeing a continuation of the disinflationary trend that the Fed keeps speaking about. Is there the potential for an upside surprise today? Of course, there always is. But looking where energy prices are, and ultimately the fact that interest rates are still quite high, upside surprises are going to be very, very unlikely. And if there are up surprises, I doubt it's going to have any impact on the rates markets. Now, one thing to pay attention to if there is an upside surprise is to keep a close eye on that month over month. Why? Well, if you look at the chart of the month over month, what you can see is we've been steadily sort of running at about 0.2 every single month for the last 3 prints. We did have quite a big uptick, recently in terms of the absolute change. So should we get something today, 0.3, 0.4, I'm sure that will raise a couple of eyebrows. So keep an eye on it. Very, very unlikely, very unusual. The market's not thinking anything like that. Should we get a 0.4 print in the month of month today, that will, of course, create a couple of shenanigans for the rates markets. That being said, of course, if we do miss on those inflation prints, like I said, bond markets right now are very, very oversold. The rates curve is very much oversold, and the dollar is very, very well bid. So don't be surprised to see some sort of, not necessarily profit-taking moves, but a little bit more sideways trade, in particular the dollar and the bonds, should this number miss to the downside today. Now, let's take a look at break-evens. I think this is one key thing to pay attention to. It is continuing this bit up. It's something that I think it's very unusual to see break-evens moving higher at a time when we've got a Fed that's very, very restrictive. And I suggest what the market's telling the Fed ultimately is that, yes, you've cut 50 basis points initially, you then went another 25, you're signaling another 25 for December. If you keep going on that path, you are going to be at the neutral rate very, very quickly. Okay, inflation break-evens right now are telling us that the Fed's neutral rate is significantly higher than the 2.6, which the Fed sort of forecasts on their dot plot. Okay, so keep a close eye on this, because should we see this continue to move higher, should we trade back up towards 2.8% over the course of the next 6 weeks, that's going to have implications for a number of markets. Okay, dollar will bid on that, gold will bid on that, bonds will keep offering on that. Okay, the Fed does not want to see these break-evens keep pushing higher at a time when they're cutting rates, because that would force them to pause a lot quicker than they would like. Okay, moreover, we will then have to start dealing with this idea of a much higher neutral rate, and I'm not sure the market's ready to deal with this idea of a 3.5-4% neutral rate. Okay, and again, what that means, look, if at some point over the course of the next 3, 4, 5 months the market has to digest this idea of a much higher neutral rate, somewhere around 3.5-4%, that's going to have some significant implications for a number of markets. Most importantly, equities will come under some sell side pressure as a result. Okay, now one of the key markets to pay attention to, I think this is where the trade's going to come from. This is the trade of the day. It's all about US 10-year yields. You can see very much, and again, we always want to be cautious with trend lines, but we can see that yields are sort of following this funneling kind of approach. If we go back to November last year, that's when the Fed pivoted. That's when data started becoming weak. We sold off all the way to 370. Start of this year, we saw an acceleration of inflation again. We bid back up to 460. We're now sold off when we started seeing weakening data July, August, September. Then the Fed pivoted and we got the election result. We're now at 445. The reality is that this is a very, very good topping area for yields right now. Nothing suggests that the US economy is about to accelerate to the upside. Sure, Trump's coming into power, but those policies are not going to be in place anytime soon. So, 440, 445 in a yield, even 4.5%. I think somewhere there you've got to start buying up those bonds again. And like I said, today's inflation print, that might be the catalyst for the bonds to start turn and rotating lower. Okay, don't forget, At the end of the day, to drive the long bonds, you do need economic data. We don't have any headline economic data until the non-farm payrolls at the start of next month, and that may prove to be inconclusive. Okay, so anyone that wants to be short bonds, I suspect they are already short bonds, and we're going to need to see more data now to justify a higher push in the yield market, and I don't see that coming anytime soon. So really good opportunity to start buying up the bonds. And again, if you're a little bit nervous on the long bonds, the best place to do is trade in the front end. Okay, right now I think the best play is to be long the front end of the bond curve. Should the long bonds start to offer as well in terms of yield, that will give the front end a lot more upside zoom. Okay, that is then of course our session discussion topics for today. In terms of then some of the other things to pay attention to, we have got Fed's Powell coming out tomorrow. That'll be interesting, as well as the weekly initial jobless. So we'll talk a little bit about that tomorrow. One final note, we did see yesterday a little bit of risk off. It was a sort of situation where the markets felt heavy, but ultimately they got bought up very, very quickly. I suspect we get more of the same of that today. We have got a VIX trading around 15.25, so nothing really suggests that we're going to get some significant sell side pressure. What that does mean as well is I think Bitcoin will follow a very similar pattern play to the equities, which is look for those sell-off opportunities just to simply buy up the equities. Okay, right now nothing suggests that equities are a sell, and if we do start to see these bonds move a little bit lower, if yields start to pair off, I suspect that's going to be the perfect opportunity to buy equities back up to record highs. That's a wrap then for today, guys. Good luck out there. As always, manage that risk, go make some money.